since pollution is one of the primary risks involved here, and just by way of a little bit of a background, the insurance industry was on the hook for environmental pollution based on the historical products that they had in the market. Anytime you had some kind of seepage or pollution or groundwater contamination, some of the older policies provided coverage for those, because all they did was provide coverage for property damage during their policy period. Once the insurance company kind of wised up, they started putting provisions or exclusionary languages in their policy saying, for example, a pollution exclusion. Pollution is not covered. Then the policyholder bar figured out this arguments in response to that. Well, what does a pollution exclusion do? It says if it's something that is sudden and accidental, but what if it wasn't sudden and accidental? Is the sudden and accidental the act itself, or did you intend the actual damage that was caused by it? So we got around that. Then the insurance industry wised up and they put something called absolute pollution exclusion in their policy. Basically, your bottle of vinegar at home, if it falls over and breaks in your kitchen, that could be considered a pollutant. So on and on and on, to a point that insurance industry got to a point that they said, no way, no how we cover pollution unless it's quickly discovered and quickly told to the insurance industry about. So there would be coverage for pollution types of activity if it's discovered in time and if it's reported to an insurance company in time. But if you have gradual pollution, for example, if you dig down under the ground and potentially the fracking stuff gets into the water tables, nobody realizes that till maybe 10, 20, 30, 40 years later. What then? So you could be bare. There could be gaps in the coverage for there that they're pushing back. So there are areas that they're pushing back, and there are areas that an insured needs to be very careful about how their program is set up and how their program, especially if they're in this oil and gas business, how the program set up and how the program would respond to fracking types of liabilities. There are some traditional types of coverages that have always been in place that any insurance buyer in the oil and gas industry has. For example, you have your garden variety liability policy. What does that do? That provides third-party bodily injury and property damage coverage. So if I do something to you that causes you harm and you come to me and you sue me, that general liability policy is going to respond for your bodily injury, for your property damage, and in a lot of instances relevant to the fracking business for nuisance and trespass. Your private right of enjoyment of your property, it's interfered with because you got fracking fluid all over your backyard. So those types of things, that is a staple of any insurance program, general liability policy. Now, it's important thing about a general liability policy is in most instances, it provides you first dollar defense cost. So if I come to you and say, or you come to me and say, KT, you've harmed me, I'm bringing this action against you, I need somebody to come and defend me. And God knows, in the 28 years that I've done this, a lot of times the defense cost, outweighs what I end up paying to you to settle the case by, many multiples. So the good thing about that general liability policy is that it provides first dollar defense coverage to you. They call it, litigation peace of mind. You don't have to worry about hiring a lawyer. Insurance company will do that and they defend you. So that's very key with that type of coverage. Again, a basic staple of the corporate insurance program. The problem with that policy is that pollution exclusion we were talking about doesn't provide coverage for pollution. And then you go in there and say, where does that come in? Well, 98.5% of the fracking fluid, or 99% of it water, but there's that 1% of some type of chemicals that you put in there to make the process go easier. Good enough for the insurance company. That's a pollutant, and you can't get coverage for it, so that you could get kind of pushback on that. So that you need to be a little bit careful about that, and a little bit careful about how you set up your program to get around those types of situations. Then because of that gap that exists in your liability program, there are other products in the market, like they call them pollution liability coverage or environmental impairment liability. That goes and zooms in that very specific area of pollution that you don't get coverage for, and provides coverage for that. Not only provides coverage for your third-party bodily injury, your third-party property damage, but for any type of governmentally mandated cleanup that you have to do because of your fracking activity. Well blows up, stuff gets all over the place, government comes in and says clean it up, or the state regulators come in and clean it up. You gotta clean that up. So that focuses on that very specific issue. The only concern in that coverage is they call it a claims-made coverage. And your claims-made coverage means that you gotta get the claim during your policy period, typically an annual policy period. And not only you got to get the claim during that policy, you got to tell the insurance company right away about it. If you don't do any of those two things, you're out of luck. If you get the claim this year and notify it the second year, no coverage. So they narrow the coverage to the extent that possibly they can, to make sure that it only provides coverage for boom type of events. Explosion, great coverage. But what if the material leaches on the ground and you don't find out about it for a long time? So that pollution liability coverage is out there, and some folks do purchase that. And the key thing about that is this time element that's involved in there. You got to discover the pollution in 30 days, and you got to tell the carrier in 60 days. If you don't do that, no coverage. Then the other things you have is your property policy. Everything I've been talking to you about is the harm that your work and your activity cause to a third party that you need to make whole, be it a property owner or be it the government, whoever. But then you have your own first-party property policy, like your homeowner's policy. That type of policy provides if you have some kind of damage to your real property, that policy has to come and provide coverage for you. And pretty much everybody has that. And in addition to just damage to your property, to your real property, what this property policy does for a corporate policyholder is that it provides you coverage for your business interruption. So if the well explodes and the equipment explodes and goes all over the place and your business shuts down, you're going to lose a lot of money. All this gas that you couldn't recover and sell, your business gets interrupted. Your property policy provides coverage for that. So that kind of helps you in terms of being made whole. In addition to that, there's some additional add-ons to those coverages, like civil authority. If the government shuts down the place because some mishap at the facility, or shuts down the road to your facility and you can't get into, you lose your business. So you got to be able to be made whole. The key thing about this property coverage is, so long as you can have $1 worth of physical damage to your property, $1, you can get unlimited amount of business interruption insurance coverage. Now, chances of $1 with unlimited is pretty hard, but you absolutely need that $1 worth of physical damage or injury to your property. And another area that in the oil and gas business, folks procure to protect their business is called operator's extra expense policy. Basically, these are called well blowout policies. And what happens is that if you have a well that goes out of control, you drill down and vertically, you make it L-shaped turn in order to drill down vertically. There's a stress on the corner and there's an explosion, and the well goes out of control. That owner's extra expense policy pays you to get that well under control. In addition to that, it will pay you to re-drill or restore the well that got out of control. Significant, it turns out to be significant. And last but not least, it provides you coverage for any bodily injury or property damage to people around, or any kind of above ground pollution that is caused by that well blowout. So that's a standard staple in the insurance program of oil and gas drilling companies. So those three types of policy, general liability policy, pollution liability, as well as owner's extra expense. Those are standard you see in this area. There's some other policies out there. You have your directors and officers policy that protects your corporation and its senior management in case there is a lawsuit. How come you didn't do enough due diligence to know what the downside or the liabilities in connection with fracking could be? You should have done that. You didn't. You were negligent. In doing your work as a director. People sue you and come after you. The directors and officers liability policy protects you. Then there are situations when, as part of your public disclosures, you don't talk about the hazards associated with fracking. If you don't, and there is some kind of a mishap, people are going to say, "Oh, you didn't disclose. You should have," and they bring shareholder suits against you. So your D&O policies come into play to protect not only the corporation but the individual directors and officers.